Wow, this is crazy. I'm literally staring at my screen right now, and the stock momentum in the real estate sector is just wild. I mean, we've got Federal Realty Investment Trust, or FRT, hitting a 52-week high of $126.41 recently, and their earnings are just soaring. But then, on the complete opposite side of the ring, we have Realty Income, ticker symbol O. They're up almost 17% over the past year, sitting right around $63, aggressively expanding into Europe, and now suddenly dropping billions of dollars into AI data centers. We are talking about massive strategic pivots, completely conflicting valuations, and two entirely different strategies for survival in this market. Okay, let's dive into this explainer and figure out exactly where the smart money is actually moving.
The headlines are certainly loud right now, but to understand this properly, we must look strictly at the underlying data. The market is currently trying to price in a massive, fundamental divergence in business models. If you look at the fundamental data provided by the Motley Fool and Simply Wall Street, it proves there is a clear structural showdown happening here. It is a battle between premium coastal concentration on one side versus massive, automated international scale on the other. We are not going to speculate today. We are going to break down the exact numbers driving these two real estate investment trusts and interpret what those numbers mean for their future cash flows.
Okay, so we're looking at the three hidden drivers behind the headlines: shifting interest rate pressures, sudden cuts to EPS guidance, and massive pivots into digital infrastructure. There is clearly a lot of noise out there. Between the interest rates, retail bankruptcies popping up, and this sudden rush to fund AI, it honestly feels overwhelming. What is actually moving the needle here?
Let me break this down for you logically. The data shows that these three core factors are actively moving this sector right now. First, shifting interest rate pressures are heavily impacting borrowing costs for real estate acquisitions. Second, sudden cuts to EPS guidance are making investors question short-term profitability. And third, massive pivots into digital infrastructure represent a fundamental shift in how these companies view their future survival. Let's look at how these three drivers build into their actual day-to-day business models.
To properly analyze the financial data, we must first establish their operational structures. The data shows two completely opposed strategies. Federal Realty Investment Trust owns roughly 104 properties. These are highly concentrated, mixed-use retail properties located exclusively in densely populated, affluent coastal markets. In 2025, the data indicates they generated $1.3 billion in revenue from just those 104 properties. Wait a minute, doctor. What does that have to do with our stock accounts? That's too complicated. Could you give a simple analogy? For someone who doesn't track commercial real estate every single day, how do we visualize this difference? Certainly. Think of Federal Realty as a highly profitable, premium neighborhood lemonade stand. It is located on the single most expensive street corner in town. It only has one location, but it charges absolute top dollar, and the customers are very wealthy. Conversely, look at the data for Realty Income. They operate over 15,500 properties across 50 states and Europe. They utilize what is called a triple net lease structure, meaning the tenant pays the taxes, the insurance, and the maintenance. If Federal Realty is that premium lemonade stand, Realty Income is a massive automated global vending machine network. It relies on sheer scale, high volume, and highly predictable low-maintenance cash flow. Oh, wow. Okay, that perfectly illustrates the difference. 104 elite, expensive properties versus 15,500 standalone buildings just quietly doing their thing. So what you just said basically means the crucial question is whether it's better to own a few highly expensive coastal city blocks or thousands of 7-Elevens and Dollar Generals spread across the entire globe. Let's dig right into the financial realities of these two completely different models. We are now moving into the financial deep dive. If you look at the data here, sourced directly from Financial Modeling Prep and Simply Wall Street, you will see a severe valuation reality check. The U.S. retail REITs industry average trailing PE ratio is 26.8x. Furthermore, the SPDR real estate sector benchmark forward PE is 32.2x. However, the data shows Federal Realty trading at a forward PE of 42.9x and Realty Income trading at an astonishing trailing PE of 53.1x. OMG. Really? Wait a second. 53.1 times earnings? I am looking at these numbers right now, and I have to demand some answers here. Why on earth are we paying a 53.1x premium for Realty Income or a 42.9x premium for Federal Realty when the entire sector benchmark is sitting way down at 32.2x? That sounds like the textbook definition of completely overvalued.
Why is the market going wild for these stocks when we are paying such massive, massive premiums? The numbers reflect the premium the market places on reliability and institutional quality, but it also clearly signals valuation risk. Simply Wall Street's analysis explicitly points out that trading at 53.1x points to a rich setup rather than an obvious bargain. Investors are paying up for the proven safety of Realty Income's 114 consecutive quarters of dividend increases. For Federal Realty, the market is aggressively pricing in their outstanding Q1 performance, where their diluted EPS soared to $1.81 from just $0.72 in the prior year. The high multiples indicate that expectations are currently priced for absolute perfection. Any deviation from that perfection exposes investors to severe multiple compression. So what you just said basically means we are paying absolute luxury prices for both of these stocks, and if they stumble or miss even one single step in their earnings, their stock prices could completely fall off a cliff to meet that sector average.
Exactly. And to understand why the market currently tolerates that luxury pricing, we have to look directly at the free cash flow. The data here is definitive. Free cash flow is the cash from operations minus capital expenditures. It is the actual cash left over to pay dividends. For the 2025 fiscal year, Federal Realty generated $331 million in free cash flow. Realty Income, driven by its 15,500 plus properties, generated a staggering $4,000 million, which is $4 billion in free cash flow. $4 billion in free cash flow. That is an absolute mountain of cash. And honestly, this brilliantly illustrates exactly what you meant earlier by the global vending machine versus the premium lemonade stand. Realty Income is just printing money on a totally different global scale. The numbers mathematically prove the advantage of scale. Realty Income's triple net lease model means they are not burdened by sudden maintenance costs, roof repairs, or property tax spikes. Those costs are legally passed directly to their tenants, like Walgreens and FedEx. This results in a highly predictable, massive cash stream that allows them to fund their monthly dividend consistently regardless of inflation. Federal Realty's cash flow is very strong for its specific size, but it is fundamentally limited by its smaller, highly capital-intensive footprint. Furthermore, if you look directly at the cash flow statements and the balance sheet data, we can accurately assess their financial safety profiles. As of the December 2025 balance sheet, Federal Realty had a debt-to-equity ratio of 1.5x. This means they carry $1.50 in total debt for every single dollar of shareholder equity. Conversely, Realty Income maintained a much lower debt-to-equity ratio of 0.8x. Okay, help me translate this. I hear you on the balance sheet data, but what does that 0.8x versus 1.5x actually mean for my portfolio's safety? Look, I'm just a regular investor trying to make sense of these ratios. It means Realty Income operates with significantly less leverage relative to its equity base. In financial terms, lower leverage directly equals a lower risk of default, particularly in our current high interest rate environment. Now, Federal Realty's current ratio, which measures short-term asset to liability coverage, stood at 1.0x, while Realty Income was slightly lower at 0.5x. However, while Realty Income has a lower current ratio, their massive $4 billion free cash flow generation and their 0.8x debt-to-equity ratio provide a fundamentally safer overarching leverage profile compared to Federal Realty's 1.5x. So what you just said basically means Realty Income has a lot less debt weighing down its massive pile of cash, making it a significantly safer bet if the economy takes a sudden, unexpected nosedive. But hold on a second. If they are so safe and they are making so much cash, I have a massive bone to pick with them on this next slide. I have to push back fiercely right here. You are sitting there telling me Realty Income is a cash printing machine with low debt. They are making good money, so why is the stock price reacting to negative news? Because the Motley Fool data explicitly states that Realty Income literally just slashed their 2026 EPS guidance from $1.65 all the way down to $1.60. Meanwhile, as we just talked about, Federal Realty's Q1 EPS soared up to $1.81. Why on earth should the market trust Realty Income when they are actively lowering their own earnings expectations?
The data requires careful, objective interpretation here. The EPS cut for Realty Income must be viewed strictly in the context of their capital expenditures and structural share dilution. When a real estate investment trust acquires new properties or enters massive joint ventures, like the data center expansion we will discuss shortly, they typically issue new shares or take on short-term debt. This action temporarily dilutes the earnings per share.
Wait, so they are intentionally sacrificing their short-term earnings per share just to buy more real estate?
Precisely. The numbers show exactly that. While Federal Realty is currently benefiting from high rent realization and the strategic turnover of their premium properties, which successfully boosted their short-term EPS to $1.81, Realty Income's Q1 diluted EPS came in at only $0.33. The reduction in their future guidance to $1.60 directly reflects the upfront costs of aggressive global expansion and higher capital funding costs, such as their recent 3.625% Eurobond issue. It is a highly calculated mathematical trade-off. They accept short-term EPS compression today in exchange for massive long-term portfolio diversification tomorrow.
So what you just said basically means Federal Realty is maximizing its profits right now, today, while Realty Income is willing to take a slight hit on paper today just to buy the building blocks for its future. Let's shift gears now and look at the actual industry environment and their economic moats. Now we transition to evaluating the industry environment and their respective economic moats. The most critical metric for evaluating a REIT's defensive capability is its occupancy rate. The data shows Realty Income possesses a 98.9% total portfolio occupancy rate across its massive 15,571 properties. 98.9%? That is basically fully booked. How is that even physically possible across over 15,000 separate buildings spread out all over the place? It is proven directly by their tenant strategy data. 78.9% of their portfolio is anchored in retail, and 15.5% is industrial. Their top tenants include strictly necessity-based businesses like Dollar General, 7-Eleven, and FedEx. The data points to a deeply mission-critical real estate strategy. These are not speculative, high-end office spaces that sit empty. They are local convenience stores, vital distribution centers, and neighborhood pharmacies. The tenants absolutely require these specific physical locations to operate their core businesses. Therefore, the rent collection remains incredibly robust regardless of broader economic cycles. This 98.9% occupancy is the undeniable mathematical proof of their economic moat. Wow. So even if there is a horrible recession, people still have to go to Walgreens to get their medicine, and they still go to 7-Eleven, so Realty Income still gets paid its rent. That is an incredibly solid moat. But nothing is invincible. What are the fatal flaws here?
You are correct. Every business model carries inherent risk. If you look at the fundamental data from The Motley Fool and Simply Wall Street, the fatal weaknesses for both companies are clearly defined. For Federal Realty, the primary risk is severe geographic and structural concentration. They rely heavily on just a few major, highly affluent coastal metropolitan markets. If an economic downturn or demographic shift hits those specific affluent regions, it disproportionately impacts their rental revenue. Furthermore, they are highly vulnerable to large retail anchor bankruptcies. If a massive multi-level anchor tenant leaves one of their properties, that premium custom-built space is incredibly difficult and expensive to fill quickly. Okay, so FRT basically has all of its extremely expensive eggs in just a few very expensive coastal baskets. What about Realty Income? What's their kryptonite? Realty Income's risks are directly tied to its massive ongoing expansion. The data highlights rising capital costs in Europe as a primary immediate threat. Their model relies on consistent, cheap access to unsecured debt to fund new acquisitions. If European interest rates remain high, it mathematically squeezes their acquisition yields. Secondly, there is significant execution risk in their brand new digital infrastructure investments. By doing this, they are moving away from simple, predictable convenience stores and directly competing with highly specialized tech real estate firms. So what you just said basically means FRT's biggest risk is a localized retail crash in a wealthy city, while Realty Income's biggest risk is literally choking on its own massive global growth and taking on debt it can't out-earn. And speaking of that brand new digital infrastructure investment, let's look at these wild numbers. $6 billion. I'm sorry, I am looking at this number straight from the Realty Income press release, and I am in absolute shock. They sell real estate for Dollar General and LA Fitness. What on earth are they doing playing around with $6 billion in the tech space?
The data indicates a massive structural, strategic pivot for the company. Realty Income has officially formed a programmatic joint venture with Cloud Capital and a global institutional investor to invest aggressively in hyperscale data centers. The initial seed assets for this new platform are valued at over $6 billion.
Wait, so the global vending machine company is now out there building the internet? Why is a retail REIT suddenly playing in the AI sandbox? This seems totally out of left field. What does this have to do with our stock accounts?
It has absolutely everything to do with securing their future cash flows. The retail real estate market has inherent physical limitations. To maintain a growth trajectory that mathematically supports their current $59 billion market cap, Realty Income must tap into macroeconomic megatrends. The data shows they expect to invest up to $1.4 billion for a 45% equity stake in a specific three-asset Northern Virginia portfolio. This is not a random speculative pivot. It is a highly calculated entry into the digital infrastructure required to support the explosive growth of cloud computing and artificial intelligence.
Let me break down the exact mechanics of this hyperscale AI moat for you. The data reveals exactly why Realty Income made this specific move. First, the $1.4 billion initial commitment is strategically located in Northern Virginia, which is globally recognized by the industry as Data Center Alley. Second, and most importantly from a cash flow perspective, these assets are underpinned by massive 15-year to 20-year triple net lease agreements.
Okay, 15 to 20-year leases. That is a seriously long time to guarantee rent checks.
Exactly. And third, these leases are signed exclusively by investment-grade hyperscale tenants. These are the massive, extremely well-capitalized technology companies that are actively driving the AI revolution. By taking their traditional, proven triple net lease model and applying it directly to digital infrastructure, Realty Income is attempting to lock in guaranteed, inflation-protected rent escalators for the next 2 decades from the wealthiest tech companies in the entire world.
So what you just said basically means they aren't actually changing their core business model at all. They are just swapping out the local 7-Eleven building for a giant server farm and swapping out the convenience store owner for a trillion-dollar tech giant. That is actually pretty brilliant when you put it like that.
It is a mathematical and operational necessity. The data confirms that Realty Income's core corporate identity is literally trademarked as the monthly dividend company. They have systematically raised their dividend for 114 consecutive quarters. To sustain that specific streak, the financial engine must constantly adapt to find new revenue. The expansion into European real estate, the 3.625% euro bond offerings we discussed, and now this $6 billion data center joint venture are all mathematical necessities. They're designed to ensure the free cash flow continues to fully cover their current 5.07% dividend yield while successfully navigating rising global capital costs.
And this brilliantly illustrates the immense pressure they are under. When your entire corporate identity is based on paying a monthly dividend without fail, you have to constantly hunt for the biggest, safest cash cows on the planet. And right now, that means AI data centers. But what happens if this multi-billion-dollar bet goes wrong? Let's move to our survival scenarios.
All right, we've looked at the history and the current data. Now let's look at the forecast. 3 highly specific survival scenarios for Realty Income over the next 12 to 24 months. The first scenario is the bull case, or the optimistic outcome. The trigger for this specific outcome requires 2 exact conditions to be met. First, the $6 billion data center joint venture must successfully achieve its planned yield expansion without any major cost overruns. Second, European macroeconomic debt costs must stabilize and fall, which would allow for much cheaper future bond issuances.
And if they manage to pull off this perfect storm, where exactly does the stock go?
The numbers point to a highly specific target. Simply Wall Street's widely followed narrative models a fair value of $70.93 per share, which is based on comprehensive discounted cash flow models. Currently trading around $63.84, this represents an approximate 10% undervaluation based on current market pricing. However, if the market fully recognizes the success of the digital infrastructure pivot and the extreme safety of those long-duration tech leases, the stock will re-rate upwards. It would aim to close that 42% stated intrinsic discount in the models and aggressively approach the $70.93 fair value estimate. So, what you just said basically means if the AI server farms actually print money the way they hope, and borrowing money in Europe gets cheaper, the stock has a mathematically sound, data-backed runway right up to $70. But hey, I'm the devil's advocate here. Give me the absolute nightmare scenario on the next slide. The bear case, or pessimistic scenario, is heavily grounded in valuation risk and fierce market competition. The specific trigger here is intense, unmanageable competition. Realty Income is now stepping out of its comfort zone and competing directly against deeply entrenched, specialized tech REITs like Equinix and Digital Realty for these hyperscale assets. If this intense competition forces Realty Income to overpay for data center acquisitions just to win the bids, it will severely compress their operational yields.
And if those yields compress, what happens to that massive 53.1x PE ratio we were freaking out about earlier?
The data shows it becomes a catastrophic trap for investors. If high capital costs squeeze the tight margin that funds the sacred monthly dividend, the broader market will abruptly realize that a 53.1x trailing PE ratio is heavily overvalued for a company with shrinking profit margins. The stock would likely experience severe, rapid multiple compression. It would drop down aggressively toward the U.S. retail REIT's industry average PE of 26.8x, resulting in a massive and immediate loss of shareholder value.
Oh, wow. So if they get outplayed by the tech specialists who actually know data centers inside and out, that luxury price tag completely vanishes, and the stock price gets brutally cut down to reality. That is a terrifying risk. So what is the middle ground?
The base case.
which the historical data strongly suggests is the most mathematically probable outcome, is the neutral scenario. The trigger for this is simply the steady, monotonous execution of their core legacy business, quietly collecting rent across their 15,500-plus triple-net lease properties, while the new data center joint venture scales up slowly and cautiously in the background. Honestly, monotonous is pretty good when it comes to relying on dividends. What is the actual outcome here? The Simply Wall Street narrative confirms that in this specific scenario, Realty Income will continue growing its dividend at a steady rate closely aligned with broader macroeconomic growth, which is approximately 3% annually. It won't offer explosive tech-like momentum, but its extremely low uncertainty and its reliable 5.07% dividend yield will act as an incredibly safe, low-volatility income harbor for dedicated dividend investors. So what you just said basically means the absolute most likely future is that Realty Income just keeps being totally boring, keeps collecting rent checks from Dollar General every month, and slowly grinds out a reliable 3% growth rate year after year.
And honestly, boring is exactly what income investors want at the end of the day, which brings us to the perfect summary of this entire showdown. The legendary John D. Rockefeller famously said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Whether you are betting on the premium, concentrated luxury of Federal Realty's elite coastal empires or the massive, automated $6 billion AI-infused vending machine of Realty Income, it all comes down to reliable cash flow. The market noise, the AI hype, and the interest rate panic will always be there, but the raw data proves that the ultimate objective for these REITs is protecting and growing that monthly payout.
Thank you so much for watching today's Explainer. We absolutely love breaking down the hard data to show you the real whys and the future scenarios hidden behind the stock tickers. Your subscriptions, your likes, and your incredibly supportive comments are a huge encouragement for our Explainer production, and they help us keep diving deep into the numbers every single week.
But before you go, I want to hear directly from you. Look at all the facts and data we've laid out today. Is Realty Income's massive $6 billion pivot into hyperscale AI data centers enough to successfully secure the next 57 years of dividends? Or is the focused, concentrated safety of Federal Realty's premium coastal properties the much smarter, sharper bet for your portfolio? Let me know your strictly data-driven take in the comments below, and we will see you on the very next Explainer.